Hi, everyone. It looks like we already have quite a few attendees, so we'll make a start. We have 3 sessions today, and so we'd like to jump right into them. We have firstly Claudina Taylor from the ONS. After that, we'll have Rachel Soloveychik from the US Bureau of Economic Analysis, and then me, George Vasilev, also from the Office of Financial Statistics, will present on my slides. Firstly, just to, in case this is your first session, to explain the interactive process, you will see a Q&A box at the bottom of your screen. If you could please write your questions down within there. The regular chat function is disabled, so if you have any questions, then please write them onto Q&A, and then I will be bringing people in by calling your name, and your microphone will be unmuted for you to ask the question. This will be at the end of each one of the slides, but you can write down your question at any point during the meeting. After the session is a coffee break, so if you'd like to continue the conversation, you can head over into the breakout rooms there and continue what will hopefully be a set of interesting Claudina.
Hello, right here, let me share my slides. Okie dokie, can you let me know if you can see those, Georgie?
Yes, we can, Cleona.
Perfect. I'll jump ahead then. So first off, just to introduce myself, hello, I'm Cleona Taylor. I work at ONS and I'm Head of Research Partnerships. And this is going to be a presentation exploring the questions and the possible approaches that you can take to valuing free digital platforms in a national accounting framework. So the things that we're going to be going through, first I'll just go through a bit of motivation and introduction to what this is actually going to involve. And then we'll start to touch on some of the key conceptual issues that you need to really start getting involved in before thinking about how you'll approach this work. Then we'll go into a taxonomy of the free digital products to try and better elaborate on what we might be referring to when we think of free digital products. Then we'll move on to taking a look at some of the different approaches for some of the key conceptual bits that are most difficult to fit in with a national accounting framework and the different effects that they would have on accounts. And then finally, we'll follow through some of the issues that come out of that. And then we'll go on to any questions at the end. So first off, let's talk about that motivation and that introduction. So why are we actually interested in this? Why is it worth spending time on? So from the ONS's point of view, there are at least 3 reasons that we're quite interested in this. So I'd say the first one is the productivity puzzle, which is there's a global phenomenon of a slowdown in productivity growth. But in the UK in particular, it's been quite pronounced. So on the left-hand side, we've got a chart showing GVA per hour over the past few decades. And prior to the economic downturn in 2008, 2009, labour productivity grew at just over 2% per annum pretty consistently. But since then, the UK experienced a substantial slowdown in growth, such that if it had grown at its pre-downturn rate, productivity in the UK would be around 30% higher than it is currently. And this has all sorts of interesting implications, interesting questions around it. The first one is just a question about whether we're measuring things correctly, and that's been a key question for ONS. But another one is whether there's something going on here about where the conceptual boundaries of GDP play a role, and whether there's any process by which productivity growth that once went into a market economy or once went into the production that is bounded within GDP has now shifted to outside of the production boundary, as well as lots of other questions around the productivity puzzle. But we're interested in that. The second concept really comes into the beyond GDP agenda. and the importance that free digital products could play in a broader concept of economic welfare. So a little bit of motivation is the fact that we do know from time use surveys that people do spend a substantial amount of time consuming free digital products. And we know from the work by Dan Coyle and others that the usage of these products is quite high and people can value them quite high. And within ONS in particular, we have a forthcoming paper as part of the ESCoE working paper series, following on our spectrum concept. And I'd encourage people to go to Richard Hayes's presentation tomorrow, exploring some empirical work we've done on this, where we are exploring the idea of expanding the production asset boundaries associated with national accounts, but still taking a national accounts approach to how we measure production, and the role that free digital products could play in that expanded measure of economic welfare. And then finally, ONS as an organisation was encouraged by the Bean Review in 2016 to think more broadly about the role that data and the digital economy play, and that the statistics that we produce at the moment aren't producing the sorts of numbers that users need to really evaluate the role that the digital economy is playing and that data is playing in the modern economy. So we have quite a lot of motivation as ONS to be exploring this. So as I've touched upon, this work springs out of the spectrum work that we'll be doing. But again, I encourage you to go to Richard Hayes' presentation tomorrow to look at that. And that's really exploring the possibilities of an expanded measure of economic welfare, but still following national accounting principles. So it's thinking about things like satellite accounts and bringing satellite accounts together to produce an expanded idea of what the economy could be. And that sort of process does come up with some caveats that it's important to talk about first. So one thing is that here we're not going to be talking about within this presentation things like consumer surplus and externalities. We're talking about the concept of value that typically national accounts deals with, which is produced value. Which then leads the question, why exactly would we want to do that and take that particular approach? So taking the broad question, why would we want to measure the free digital products in the first place? Again, we can go back to the Stiglitz Commission and the Beyond GDP agenda, and that thorough idea of you can better change, manage, encourage what you can measure, and that as a society we value what we measure and we measure what we value. But thinking more specifically about why would we want to measure this within a national accounts framework, again, we're thinking about the extent to which free digital products could be an avenue for improving people's quality of life. And the key thing about the national accounts framework and placing it within that framework is that you can then compare and contrast with a lot of useful features. You'd have a lot of comparable data with which to ask questions. Does this add more or less value than other areas? How does the productivity of particular things compare? How does it fit into particular production processes that, again, we have value on hand to be able to compare that with? So there's a lot of advantages of fitting this particular bit of work within a broader framework that we have within national accounts. So with all that motivation, the place that we want to start at is taking a rather broad definition of what free digital products are. And taking that broad definition is rather useful because we can then start to unwind all the different implications that could come out of that. So we're going to start with this really broad definition and drawing quite heavily from the international, in particular OECD work around measuring the digital economy more broadly. So we're going to think about products which are digital in nature. So that includes digital technologies, digital infrastructure, services, and data. So actually digital in nature, as well as products which are not digital in nature, but are delivered through digital means. And then finally, the point about them being free, we're just going to then take that concept and we're going to focus on those digital products which are received free at the point of use by the majority of their consumers. And we'll unpick this and follow the sorts of avenues down which it can lead. But one important thing to note about the fact that we are taking this broad concept is we are going to consider the possibilities, for example, of the fact that consumers can, yes, be households as they're typically considered, but they could also be businesses in the form of intermediate consumption, for example, or they could be government. And similarly, we'll also consider the possibility that the products could be produced by multiple sectors of the economy, including household production and government consumption of free digital products. So with those introductions and motivations, there are a couple of conceptual issues to start introducing so that we can actually get into the nitty-gritty of things. An important first conceptual point to bring up for those unfamiliar with the literature is the distinction that's sometimes drawn between a bundling approach and a bartering approach when thinking about free products. So this is a very slimmed down and simple way of thinking about it. The bundling approach considers free products as being part of a bundle, where they're financed indirectly by a paid for part of that bundle. And the free aspect of that bundle can take the purpose of, for example, helping to promote the paid for part, but conceptually they're tied together, and that in that respect, the free product is paid for by the paid for part of the production process. And when thinking about their inclusion within the National Accounting Framework, to a certain extent, they're already included because we include the paid for part. So the example is often given of Adobe, where they give away their reader for free to draw people into the use of PDFs and these sorts of products, so that then they can encourage the use of their paid for products of the editing software, for example. So then the other approach for considering this is the barter approach, or to simplify, where the free digital product is considered to be some sort of an exchange via a non-monetary means. So, for example, you could have very traditional barters of different goods being exchanged. But in the case of some free digital products, people often talk about data being exchanged for those free digital products. So you can have that different barter approach. So we're going to be considering just specifically the barter approach here. So just to be upfront about that, it isn't necessarily an argument that this is the approach to take, the best approach to take, or the only approach to take. What we're going to be doing here is just exploring that approach and seeing that that approach may yield some economically significant or insightful results. So just to be clear that's how we're approaching this here, the idea that this approach could still provide something that's economically insightful. And so a second point to bring up that for the purposes of a national accounting framework, ownership is incredibly important. And especially when thinking about an exchange for barter purposes, we need to, for a barter to be able to take place, there needs to be something which can be bartered and that can have ownership rights, which can be bartered and can be exchanged. Otherwise, an exchange doesn't take place if you're exchanging something that you don't actually own. So when thinking about this, we need to be conscious of the fact that whatever is involved in the barter, we need to have some idea of the fact that that can be owned. And then finally, a useful distinction that has been drawn, but again comes with its own questions, that's worth bearing in mind is a distinction that's sometimes drawn between observable phenomenon and data. So don't worry, we'll get into this a bit more later in the specific use that it can have. But so observable phenomenon specifically are the actual real world phenomenon that could be observed, so the amount of rain that fell in Brixton yesterday. And it's non-produced, which means that it doesn't generate any value added. But then there's data, which is a recording of those real world phenomena. So carrying on the example, it's the measurement of the amount of rain which fell in Brixton yesterday. And that collection of that data and that process of recording can be deemed to be a production process, and therefore could be deemed to add value. But even just introducing this concept, I've given an example of a split where it's really easy to distinguish between the two concepts, but it's worth pointing out that it isn't always easy to distinguish what the actual real world act is and what the recording of the data is. For example, just drawing the example of even a tweet, whether there's any, whether it's possible to conceptualize a tweet that's abstract from the data, the text data that makes up the tweet. So it's important to bear in mind that even drawing that distinction in practice, it can be rather difficult to distinguish it between the two. But with those laid down, we can actually get into a bit of a taxonomy of what free digital products are. So what I want to do here is just start to introduce some different kinds of free digital products, and then think about whether they're already included in national accounts, and we probably wouldn't need to change them to think about them in the way that we want to. Whether they're included in national accounts, but the introduction of a barter might change them, and whether they're currently not included in national accounts at all, and there'll be a process of introducing them through household production or something similar. So we can think about some really simple cases of a direct product where it's all contained in one product. So for example, we'll start off first by thinking about a perfectly free digital product. What I mean by that is something that doesn't have any direct finance or indirect financing to it. It's just produced, for example, by a household for free. So if I develop a personal website and I pay completely for the domain and I pay for the website so that it doesn't have adverts and I just use it as a personal blog, and I provided that perfectly free. There's no financing of it. It's just there. But we could have an advertisement-funded website, such as BuzzFeed website, so you still don't have to pay to access it, but it's paid through advertisement. Or you could have a freemium product, where there's a free aspect of that product, but there's also a version of it that you pay for, which we might consider within national accounts, that because there's a part of it that's being paid for, then that is already included. But one of the areas that I want to draw out that can start to make this a little bit more complicated, but also more interesting, is introducing digital platforms as actually the concept through which quite a lot of free digital products are now provided. So, and these can broadly be split into, just to simplify, two different platform mechanisms. So advertisement-funded platforms, as well as donation-funded platforms, at least when it comes to free digital platforms. Of course, there are platforms that you could pay for access to, but these are the kinds that could be provided free. So taking advertisement-funded platforms, you have an example of YouTube, for example. And then donation-funded platforms, you have something like Wikipedia. But when you approach digital platforms, it's then important to acknowledge that when thinking about the free digital product, actually quite a lot of that, when you want to dig into the value associated with that product, you actually want to dig into the content provided on that platform. So then you can break it down further and have a look how that content is funded. So again, having a look at advertisement-funded platforms like YouTube, you could have a look at content that is provided perfectly free. So if I just post a funny video of my cat on YouTube, it's perfectly free. But even within YouTube, you can then have videos that are provided that have their own specific advertisement funding, such as makeup tutorials that are funded via product placement. Or you can have content that is provided that isn't advertisement funded, but could still have a separate revenue stream separate to that provided by YouTube. So for example, there are services such as Patreon that offer funding to people who are is a way for people who make YouTube videos to be able to get their funding. And similarly for Wikipedia, again, we can think about the content provided via Wikipedia, through which that's mostly provided free, but we could still conceptually think of a donated funded platform that still hosts advertisement funded and alternate funded content. So this introduction of the digital platform begins to introduce a more complex mechanism for valuing, for picking together all the gross output associated with ad-funded digital platforms, which I've just summarized here a little bit. So within the red, and this is just for illustrative purposes, but so while you'd want to start with just valuing specifically the value added by the platform itself, which could be advertisement funded, You would then also want to value the content. And specifically, you'd have to delineate which content was produced by households, which content was produced with ad funding, and therefore needs to have a barter imputed for it. And then that content which is provided by other funding, which doesn't need a barter imputed. So this is just following through with the structure that we put together there. We can get to this more generalized way of conceptualizing a free digital platform and how we'd go about valuing the output associated with that platform. So the key part of that, where we're going to have to think more thoroughly about the concepts behind this, again, is the aspect of that that's associated with the barter. So now we're going to consider some of the different approaches that we might take for conceptualizing exactly what happens in that barter approach. And I'd like to introduce three, and I'd also like to provide a little bit of thanks to Dylan from the BA, who's been working with us on some of these conceptualizations. So first off, I'd like to introduce the idea of conceptualizing the barter that takes place as when consuming a free digital product that's provided via advertising, as the barter of a feedback service. So let's follow through the different aspects of this. So first off, what is the transaction of the barter that takes place? So in this conceptualization, what's being bartered is the production by the household of feedback services. So very similar to a beta tester or oh gosh, the word has slipped my head, a control group, a feedback group that may evaluate your product for you. The household, when it's consuming a free product, also engages in a productive process of feeding back to the business about that product itself. So thinking of YouTube as an example again, the user provides information about how long they consume that video for, which videos that they consume that the company can then use to train their algorithms and both either improve their digital product itself, improve YouTube, so it's better at recommending videos, or improve the advertisements that they provide. So then what's going on for how we would value this transaction? So in the transaction of this from the free digital product, for the feedback services, we can value this using the sum of costs approach for the production of the free digital product. What's the household doing in this interaction? So they're consuming the digital product as intermediate consumption in part of their own household production process. And then the business takes these feedback services and uses them to create a data asset. So these feedback services are part of a production process of a data asset that the business can then use to improve its own production of YouTube or of advertisement services. And the results of the account is that here really we are creating an extra realm for household production, and that adds to the value added through that household production. Let's think of a different way of conceptualizing this. So that process was really thinking about the household being involved in production, but it's possible as well to think about a situation where the household isn't actually involved in the production process. So in this case, you can conceptualize the household as selling a license, a right to observe their observable phenomenon. So we introduced this conception of observable phenomenon earlier, where they're non-produced. They're just the things that the household does while it's enjoying its consumption of YouTube. It has particular observable phenomenon, the way that they consume YouTube. And that there's an implicit agreement that when the household visits YouTube, that in exchange for being able to consume YouTube, they also give a right to observe some of their observable phenomenon that they are engaging in while consuming YouTube. So the difference that this then produces is that the household is not engaged in a production process, they're involved in a consumption process. And the implication that this has is that there's imputed income that the house are getting through the selling of this license, which they then directly consume by consuming the product itself. So it's effectively that when you consume YouTube, this is the example that I've chosen, that Google effectively gives you an imputed amount of income, which you then spend on the consumption of YouTube. So this increases value added through the company's production of the digital product, which is consumed by the household. It also increases household expenditure and increases household income by a completely offsetting amount. So expenditure and household income increase by the same amount. But this has also highlighted the importance that the household has had in all of this process. And when we've been thinking about expanding our concepts of economic welfare, I think it's also important to consider the possibility of embedding something like the right to observe into a broader concept of household production. So we have one additional caveat on the right to observe, where instead of interpreting the household's actions as being an act of final consumption, it could be an act of intermediate consumption in another act of general household production. So a good example of this might be something like Google Maps, where the household consumes the product, but in the production of household transport services. So again, the difference in this scenario would be actually because that moves from being the production of a final consumption, instead it's the production of a free digital product for the purposes of intermediate consumption. And in this case, we also already would have valued total gross output of household production elsewhere. So just introducing another thread in that process would not actually increase value added overall for the economy, but it would still continue to expand household final expenditure and household income. So I'm just aware of time here. So some implications that come out of this. The first are implications for the approach that we're taking here for barter. So one of the things to draw out from this is that in some previous work, a barter has been proposed where, for example, in the consumption of television advertisements, the consumer has been assumed to be producing viewership services and exchanging those in exchange for advertisement-funded television. And a criticism that has often been that because of the voluntary nature of consuming those adverts, of engaging in that exchange, that the voluntary nature means that an exchange hasn't taken place there, therefore a barter hasn't taken place. So one of the things to draw out from this, in the approaches that have been provided here, for free digital products, and digital products in particular, the advent and the use of data and the recording of data does add a particular new level to that. That a lot of these barters that are being proposed are now drawing on this idea that there is an exchange taking place that is much less voluntary. That when you are consuming a free digital product, the collection of data is now rather built into the consumption of that product, and therefore the voluntary nature of the barter is much more reduced. Another implication that has come out of this quite strongly is that
Claudna, sorry
yes.
to cut you off mid-flow, but if you can really try and wrap it up to give people a chance for questions.
Oh, sure. Another aspect of this is it's quite heavily tied in with the production of data. That, as we've spoken about, a lot of these conceptualizations have the production of data as part of that process. Another aspect of this is that thinking about production boundaries is a really key part of how we might want to approach the inclusion of digital platforms within a framework, that it might make a lot of sense to embed the framework for free digital products within a framework that includes household production more generally, particularly as households may be producing a substantial portion of the content included within free digital platforms. And finally, there are implications for the particular form of welfare measurement that we look at. As we looked at before, it does depend on whether you look at gross value added, household expenditure, or household income when it comes to whether the inclusion of free digital platforms would actually change your measure of welfare. So again, this encourages a multi-measure approach to looking at welfare to make sure that we're properly capturing things like free digital services. And I will end things there so that people have time for questions.
Thank you, Claudia. I'm just conscious that we've gone over the half an hour, so I'm going to recommend we move on to Rachel and recommend that people put in questions, continue to put in questions in the Q&A, and if we have time, we can pick them up at the end, but not to cut into Rachel's time. So, Rachel, if you can start sharing your slides.
I hope people can see me and hear me. I should warn you that I have some construction going on, so if you hear loud noises, I apologize. So I really enjoyed, all this discussion about free content, and John Samuels and I have done some work, and we have our own perspective, but we're sort of approaching a free here. We're studying something that they might call free, but isn't really free. It's bundles. And so, in the United States, it's best known, buy one, get one free. Nobody really thinks it's free because you can't just take the one that's the second one. It's just a half price. And normally it doesn't really affect measurement because, you're paying the same amount of money and you're getting the same amount of yogurt in the end, labeling on the receipt. But it does matter when capital is bundled with intermediate inputs. And so just the way GDP is constructed, capital is counted when it happens and when it produces a stream of services. So when you call something capital, nominal GDP and nominal investment just mechanically go up. And so what our project is, we're going to just trace through on all of these things. And we're going to study well-known bundles. We talk most about smartphones because they're obviously a good that's often bundled, but we're going to start out with vehicle warranties because at least in the United States, it's such a nicely behaved study of bundles. And of course, you also have warranties on other goods as well, but those tend to be less important. And so what we find is if you unbundle smartphones, you actually have impact of increased investment, and you also have some changes to real GDP growth. Are not by themselves, critically about smartphones. And if you do it as a share of the telecommunications industry, it's, of course, much larger. So just the case study first, vehicle warranties. In the United States, vehicles are bundled with repair services. And so when you buy a car, you might have 2 years of free repairs included. And it's not like anybody can go to the dealership and say, fix my, bought the car. So it's really just, part of the payment for the car is really a payment for the next few years of repair. A consumer, it doesn't matter enormously because both vehicle repair and personal consumption expenditures is just sort of shifting which line we put them in. But when you have a business, the car, if they're purchasing the physical capital, that's investment. If they're prepaying on a repair work, that's just doesn't show up in GDP. And the nice thing about vehicle warranties in the United States is that independent dealers are the ones doing the repairs, and there's all these little rules that basically the manufacturer, independent dealers, and they have to pay fair market value, and you have all these lawsuits if any one of them steps out of line. So we sort of know how much money it costs. And since 2004, public companies have to report all their estimates of warranty accruals, and the car companies were doing that even before. And of course, the major car companies are all publicly traded. Yet is we can measure this very nicely. And so here's just a hypothetical example, to help people work through. So suppose we know that the car costs $20,000 to make, and so, but then you also have repairs of $500 a year. So the measure should be $20,500 because you're paying not just for the car, but prepaying for 1 year of repairs. And there's no vehicle repairs. The true capital investment is only $20,000. And what we're getting is we're overestimating capital because in this case, the bundle shifts spending from the intermediate to the capital. Of course, it could go the other way too. And we're going to be talking about that in a minute. And this vehicle warranty we did, it's such an easy example because, all these costs are measurable, but they're often much harder to value. The big problem is establishments, they often produce capital and intermediate jointly. If the car companies did the repair and they use the same workers, and the same intellectual property to do it, then there's almost no way to figure out, how much the cost is. They may have an accounting breakdown for internal purposes, but there's a whole lot of organizational breakdowns for, internal purposes are not economically same as arm's length transactions. And even if they have some idea based on their own studies, how much, it costs to do repairs versus new products, they don't always tell it to anyone else, let alone the government. And so it's sort of a black box for us. We see the total output of an establishment if we're lucky, and we have an idea of the, how much of those inputs are going to capital and how much are going to intermediate. And so the case study too is the free smartphone hardware that I'm very familiar with because it's a dominant way of selling smartphones around the world. And if, you went to this retail store and bought a smartphone and then activated it all by yourself and then got your own wireless service separately, it's easy to value. But companies use the same call set of workers to sell new phones, to help people set up their new phones, and also support existing phones. And just remember the rules for capital. It's not just the wholesale cost of investment, it's also any retail margin cost. So we should count the capital investment for a smartphone as not just how much it would cost if you were buying it in bulk from a manufacturer, but also how individual functioning smartphone. And so we can get bounds. It's at least the wholesale cost because, there's no way the cell phone company is making a profit, just sitting on inventory of the smartphones if they don't do anything with it. And it's at most the total cost of wireless service. And that would be the true if basically the setting up the smartphones is like all the work. And after that, there's no cost. And it's probably somewhere in between. But we can't than that. And we can't even assume it's a fixed percentage over time because it may be, say, in 1995, it was a lot of work selling and setting. People had no idea what they were and they needed a lot of hand-holding. But then there weren't many features. But yeah.
Sorry to cut you off. You're cutting off a little bit. So can you maybe try switching your video off? That might make the connection a bit better.
Can people hear me better now?
That's great. Thanks.
I don't have a great computer to Zoom from. So yeah, so we don't know the range. We can't tell anything specific. But fortunately for us, there's a previous paper that I highly recommend, just for some great empirical work. They look at the consumer bundles. And so they look at, but there's no reason to think investment isn't the same issue because a lot of business smartphones people buy individually. Small businesses might reimburse employees for getting smartphones on their own. And so what we do is we just take ours, and then we also have BA has smartphone consumer phone prices. We have wireless service prices. And so what you get, this is the smartphone is offered for free with a 2-year contract. And so what you get is that a capital investment appears to be zero, but it's really quite high. And of course, for a $80 smartphone isn't going to change, 20 trillion of GDP, but there's a lot of smartphones bought by businesses each year. So you're talking about billions and billions of potential investment in just this one capital category that we're missing. And of course, the total spending is the same. And so it all ends up, canceling out in the end, except for there's minor issues, some annual fluctuations companies are saving without being recorded. So here's the hardest part, open source operating systems. So unlike smartphones where you sign a legally binding contract saying if I get the free smartphone, then I have to have a contract for 2 years or however long. There they don't have a formal contract. It's just you really can't get apps anywhere else. There's right now a huge lawsuit and Epic Games where Epic Games is saying that it's impossible. But even at Android where it's technically possible, it's very hard. And there's separate lawsuits Android. And so from my point of view, it doesn't really matter whether it's forcing you to buy apps, collecting personal data, or show ads. What matters is they're giving you something now that's valuable, but in return, you have to basically be stuck the lifetime of the phone. And it also doesn't matter whether you get the operating system directly from Android or Apple, or if you get it from your smartphone manufacturer, which gets it for free. They're just a pass-through entity. They're the same thing as you have a lot of other pass-through entities that don't really matter. Assume is just the operating system cost. And so this is not quite right because we want to measure based on expected revenue. Expectations are hard to form when you have a rapidly changing market with also changing laws. But still, these companies are very good at predicting the future, and I can't do better than that. And we have some good data on App Store revenue numbers, and so we just take the U.S. investment as the total revenue times the share sold in the U.S. times the share of apps sold to businesses. And of course, you also have to adjust that even it's not like 100% that they collect at the App Store's payment for the operating system. About 70% of it is just developers. And that's, clearly the developers are selling a product that they're developing as it goes. Well, I'm really talking, and some of the remainder is for credit card processing. We're assuming about 20% of the money that Apple collects is payment on their operating system. And the same thing with Android. And so what we get is operating system prices of just BA has some nice pre-existing take. And so this is the same sort of accounts. The only difference is that instead of calling it hardware investment before, it's software investment now. What you get is that purchases are overestimated and measured investment is underestimated. And once again, this particular investment for one cell phone is not going to change the accounts. But if this is a common way in which software is developed, open source software is often sold on the freemium model. And so it's just very common to have the upfront cost look artificially. And so if you add up all of this upfront cost as just part of a bundle, you may have measured investment across the whole economy. And so here's just for smartphones. As people see, the revision to hardware is much, much larger than the revision to software warranties. Part of that is just because, of course, hardware, the bundles are much stricter. You really have to pay for the hardware and subsidize it more. Another is the hardware was much more expensive. And the big hump in 2007 is basically when took off. They were really expensive items that people didn't necessarily want. And then it went down, at least in the United States, in the mid-2010s, because at that point the accounting rules changed. And so now you buy the phones and just pay for it over time rather than officially having it given as a gift. But that's just U.S. accounting rules. Other countries may have different treatments. And so here's what it does to price growth, not particularly surprising. On net, the price growth is negative simply because smartphone hardware prices have been going down very fast, and that's just a known part of Moore's law. So what you get in the end is that measured inflation goes down a hair because we now are adding in some investment category. That there's almost no effect of software warranties. Small so far, and their prices haven't diverged that much from overall GDP prices. Same thing with TF, total factor productivity, where, on the one hand, you have this newly recorded output. On the other hand, you have newly recorded capital services. And these pretty much cancel out, though there's a lot of fluctuations. Some of it depends on, once you have these small bundles, if they were cancel better, but then some years the companies sell a lot of smartphones, and so the revenue might be understated. Other years, they're sort of coasting off their old smartphones and their revenue is overstated. And so just conclusion.
5 minutes on your talk, okay.
Oh, great. So just conclusion, we have a problem. The measure value added depends on whether bundles are classified as investment, intermediate inputs, or how within the bundles, how the list prices, and just everyone cares, or neither care about really how it's written down because the total price is the same. And we demonstrate this with a case study of smartphones, and we just show for smartphones it has, a small but non-trivial impact on measured investment and real GDP growth. And the big question is, we haven't yet been able to find a grand holistic solution that, takes all these problems and, piecemeal approaches are more viable. Warranties in particular are something that BEA could do because accounting rules, companies are now required to report their warranty obligations, so the data is there. And other capital assets where we sort of know production costs fairly well because there's either, a clear understanding of the costs involved or there's a clear understanding of sort of equipment that's not bundled. But just, we don't know how often, other parts of bundles happen. And sometimes people don't even realize that there are bundles until the plastic straws got controversial. I don't think people ever even thought that with the plastic straw. It was just you got a coffee and the straw was part of the transaction. But now there's a lot of people that really think about the plastic straw part. So I'm going to stop sharing my screen now and start video, see and hear questions.
Great, thanks, Rachel. So yes, just to remind the attendees if you have any questions, to please put on in the Q&A chat box. So I have just one question for you at the moment, Rachel. I found it a really interesting talk, and I'm just trying to clarify that you seem to be focusing on the measuring distinction around things like the free bundles. Do you also see a role for any issues with the conceptual boundary of what is and isn't in national accounts?
Right now, we're talking just about stuff that's unquestionably in national accounts. John and I have done a lot of work on the stuff Cledana was talking about. And of course, we definitely approve of studying that. But these things are sort of unquestionably in national accounts, unless you want to get really technical. Some open source software is created by people a job and sort of as a hobby. So there might be some minor boundary issues there, but I don't think you're required to hate your job. So I would say if your day job is producing software, then if you produce software, open source at night that's related to your day job, it's probably, just working extra hours.
Sure, okay. Okay, we have a question that's come in from John Lorenzo Pocris, if his microphone can be switched on, sorry.
Hi.
I think that's quickly done.
Hi, this question is more is addressed to the first presenter. So in the perspective of countries like the UK, so if the head offices of digital platforms such as YouTube and Wikipedia are in the US, should their services be part of imports, like household importing services from YouTube, and thus constitute a negative argument in GDP? As such, the numerator of the productivity statistics would not change, and it will not address the productivity puzzle. Yeah.
Oh. Hello. Yes, so it is a good question. It is a good point about the one of the complications of, and this counts both for free digital products as well as measuring the digital economy more broadly, that the international component of it is incredibly important. So I think very specifically your question about the location of head offices. It gets into the question of the measurement of digital trade, which we do have a team in ONS who are looking at that specifically for the paid side of things. It's my understanding that the treatment of head offices for these particular points about the trade aspects of things, it would very much matter where it was deemed that the product was created. So we would have to have an understanding of the production process for these particular parts. So, for example, if we do have a situation where you have, let's say, for tax purposes or whatever it is, that we have a company that's locating itself in the US or in Ireland or in another place, but the actual employees involved in the production of the digital platform themselves are located in the UK, then we might want to have the production of that digital service still be in the UK. But so it is about having to track the production processes for the platform more specifically. The question is complicated further, as we've discussed for the digital platforms, when bringing in the idea of content, that you are very right that it has a lot of implications for extending this to trade. So, for example, we would have to attempt to measure the extent to which content is produced in the UK and content is consumed within the UK. So if we have someone creating digital YouTube videos in the UK, then we not only need to track that production of the videos, we also then need to have an idea of the extent to which they're consuming videos from other places around the world. So trade does have a very central part in this process, and you are very right that to the extent that it involves the importing of digital services, and that would be a negative in this framework.
Thank you.
Great, thank you, Claudette. So again, a reminder, if people have any questions, to put them in the Q&A chat box. I believe actually there is one further question for the first talk from Andreas Joseph.
I don't think Andreas is in this session any longer.
Right, okay.
If I could respond to the last question, it was asked about free products, but it's an issue with bundles as well, because a lot of this capital stuff is being produced by multinationals, and splitting the cost of their, they might report total warranty obligation, amount of bundles, but splitting it by, category and country, that would be a practical issue that needs to be addressed. And sometimes you just have to make assumptions in order to get some estimate of how it should be done.
Yeah, thanks, Rachel. Do you account for that in your initial estimates, or do you assume it's all domestic?
Our initial estimates are basically, we take, for the warranties, we took the multinational, they have the ratio of warranty obligations to warranty to sales. And so we took that, have a data on, here's the for sales to businesses in the US versus here's to consumers in China. So we sort of assume it's fixed and software. For the hardware, we're very fortunate at ESCoE, Bern, and they've given us estimates in the US. So all we need to do assume is that the likelihood that you get a free cell phone is the same for business consumers as it is business users as it is for household users. So, but yeah, we have to make some assumptions about import. And I don't know how they're currently tracked in the import data, but I don't believe I would like them.
Great, thank you. Okay, just one final opportunity. So we don't have any other questions in the Q&A at the moment, so just checking if there are any final questions. Okay, if yeah, as I've mentioned before, continue to write your questions within the chat box, even if we've moved on to the next session, if that's fine, and the conversation can continue in the breakout rooms. So I will just look to share my screen now. Just checking if people can see that.
Yes, we can see it. It needs to be on full view though.
Yes, that's great. Okay, so yes, so today I'll be talking to you about ONS recent developments on the topic of human capital and how we've moved beyond current measures to explore and identify further policy needs. So first start off with some motivations around what we currently do and what we know we won't be able to do with the current methods. And then we'll take a step back actually to describe the definitions. What are we talking about when we refer to human capital, and what does ONS particularly refer to? And this really grounds our discussion, begins to tease out some of the links to the wider disciplines that have covered this literature, such as psychology, neuroscience, health science, sociology, as well as the established estimates within economics. We'll then present our new proposed measurement framework, which is an indicator-based framework on which we consulted last year, and take you through an example how we might apply this to recent work on unemployment scarring and to other future work relating to policy relationships. And before summarizing and thinking of the future data and evidence needs, I'll also describe some work that we've been doing looking at skills and earnings relationships through quite a different set of work with using commercial online job adverts data that really gets at the heart of measuring skills directly. So firstly, the topic of human capital is very well established and well founded, particularly on a theoretical basis about the relationship between human capital and macroeconomic growth, particularly in a knowledge-driven economy. There's also very strong links to productivity, as was referred to in other conversations throughout this conference. However, empirically, it's been more of a measurement issue, and some studies highlight particularly older measures using years of schooling, and there is a weak or possibly even an insignificant relationship in attributing growth, while more recent literature, such as that done by the OECD in the last few years, has taken account of the quality of education and learning, and this does show a bigger significant role. There is also the continued technological-based innovation, which stresses a more dynamic nature and which doesn't tie in as easily with the lifetime earnings methodology that we currently do, which I'll explain in a second. And the final sort of driver of us looking to develop our measures is around the use within policy. So in a UK domestic context, there is the ongoing focus on leveling up various regional differences at the quite a local level and understanding regional inequalities and how skills and education play a part in that, as well as across generations. Also the COVID recovery angle, where people returning into jobs and upskilling to pick up and remain in work and remain to progress. But there's a wider also impact in terms of learning loss and how children have potentially missed out, and how that might have longer term impacts to their human capital development as a whole. So on the right is an example from our most recent release on measuring human capital stocks. And this is using a lifetime earnings methodology, where we project forward an individual's set of earnings broken down by their age, sex, and highest qualification, and project that into the rest of their working life. That projection is based on fairly strong assumptions, such that future earnings are assumed to be the current earnings of those older than the individual, plus a nominal 2% growth. And this gives you an overall value that we can then decompose in terms of the growth, whether that's being driven by more people being within higher levels of education, which is the increase in educational attainment category there, whether there are more people of working age, which is the population category. There is an effect from aging, given that the less time you have in the workforce, you have a lower overall set of lifetime earnings remaining. And you can see that up until 2011, population growth had a much larger impact on overall human capital stock growth, but since then it's had a much smaller effect. And there also seems to be a slightly smaller effect at least from educational attainment, but particularly potentially a bigger effect coming through from aging. So this does allow us to track overall lifetime earnings trends changing, but it has baked in assuming past trends. And this is fairly problematic given the motivation we've talked about, particularly focusing on interventions and how some of these things might change, which means that you cannot assume that the way that the current earnings of older individuals will remain for the future. It also assumes away skills mismatch or even qualifications mismatch because of the fact that we average out earnings for everyone in a particular qualification category, even if they are in a job that doesn't require the level of qualification that they have. And we cannot remove factors that may be causing a different return on education. This is, again, going back on other literature that highlights the differential return on education, but it assumes all investment of education is the return to it, given that there is potentially a misleading role from the fact that parental investment also has a very strong effect. So moving on to definitions, we've been using the OECD definition from their State of the Wealth of Nations report for a while, and this focuses on the skills, knowledge, competencies, and attributes of individuals that enable them to not just participate and thrive in the labour market and more broadly in terms of their economic well-being, but also in personal and social facets of life. There is a strong set of literature on the cognitive as well as non-cognitive role of skills, and how actually some studies show more variation of the outcomes explained by non-cognitive skills, which are typically not as well measured through measures of qualifications, particularly years of schooling. Also, there is much more of a focus on acquisition, or more broadly, we could refer to this as change. And so what we're trying to incorporate within our definition and hence our measures is this wider set of definitions that have come through from other literature. So firstly, the perennial argument about innate talent versus development. If we look at Findings from neuroscience, they emphasize the role of brain plasticity throughout life. Findings from developmental psychology also highlight the role of cognitive, emotional, and social skills development, even from before birth in terms of the impact from maternal health, but also the role of a stimulating environment in providing for that typical route of development for children. There have been investigated certain elements of development like learning to walk and talk that may be attributed as effectively innate for individuals, but most of the other culturally found skills have been developed throughout a much shorter lifespan that haven't really come through from evolution's perspective. It's also really important to highlight that this is the body and mind, and it's not just the one or the other. And hence, we really consider here physical skills and physical health as a part of human capital. So it's not just focusing on their cognitive skills. Moving on to looking at biological sciences and other related topics, the interacting role of nature and nurture is demonstrated quite strongly here. For example, through epigenetic changes, this is when environmental outside stimuli influence the development of cells at the molecular level, and certain genes are switched on and off, and those genes have an impact in how people can react or can learn in a new situation. For example, stress is known through particular molecular pathways in the body to have a knock-on impact to the behavior that people take, whether that's while they're studying for homework, or whether that's trying to focus on a training course after having been bullied at work. On a longer time scale, lifestyle choices such as sleep, exercise, and nutritional intake are well recognized for optimal cognitive and physical health. And it also lowers the likelihoods of some aspects of aging, which we might refer to as human capital depreciation. Moving on to point 3 around social interaction. This is important throughout the lifespan, whether that's your peers at school and your teacher, whether that's later in life within the management structure of the workplace, or throughout life, the ongoing influence of family, as previously mentioned. For example, literature from psychology and sociology emphasizes the quality of conversations that people have with young babies and young children, and this has wider knock-on impacts to how ready they are for when they enter school, and hence ultimately into educational attainment. Moving on to the 4th point, perhaps too obviously, literature on learning and the sociology of education highlights the changing nature of what people of all ages know and can do, and how that can be malleable and influenced through differential instructional practices. Also, literature from sociology highlight the sometimes subtle mechanisms that could have long-term repercussions through the really strong golden ticket that is qualifications. For example, getting individuals to identify their gender before a maths test makes them do worse than not doing so, regardless of their ability before that. So making them identify with what might be perceived as a culturally negative influence. And this brings us on to a crucial point where actually economics has already made quite great strides, and that is in identifying the differences in people's labor income attributable to various factors. As I mentioned before, some cases, non-cognitive skills more so than typically academically rewarded cognitive skills matter more. And this is over and above the differential effect that you get from qualifications. And for another factor that's worth considering, outcome data sets that identify qualifications to a very granular level, such as the UK longitudinal education outcomes dataset, where you can identify the subject, class, and even the institution from which individuals obtain their degree. Even they highlight the remaining large earnings differences that could not be accounted for by the qualification information. So the broad message here is that we really want to be moving towards measuring what matters to human capital acquisition, so the growth and change and development. We need to measure this at a more granular, causal and individual specific level, and moving beyond simply using qualifications as a proxy. So this brings us on to our proposed measurement framework. As I mentioned, we consulted on this in the last year to try and bring together this wider set of evidence and really focus on what factors influence skills and knowledge directly, and hence what knock-on impact they have on secondary outcomes of interest that are typically measured around human capital, such as labor market outcomes like earnings and employment status. Although it's neatly phrased in a way that you can see there are different factors, they span multiple life stages, which is again an extension of how we have previously measured human capital stocks to focus across the lifespan. Some factors have an impact throughout a person's life, but they might only appear in a certain life stage, while other factors continue to be an input into skills development. However, what's really notable, and we recognize this as a continued challenge, is the non-linear and interrelated effects between these topics. And so, although important to try and identify them separately, this is a quite a challenge from the causal literature as well. So the measurement framework really focuses on identifying the mechanisms through which skills are impacted, and each set of mechanisms are grouped within themes. Some of these are fairly well recognized within the human capital literature already in terms of education, work, family and home to some degree, and even health. But we are expanding each one of these to really consider what are the drivers, what we might call the more direct causal influencing factors, and also looking at other themes that do impact on people's skill development, such as independent learning, what people train in their own free time and how else they use their time, the wider social context in terms of the social networks that people have, the relationships that bring them new opportunities for learning, as well as being able to pass on information, volunteering through those more informal labor market routes. And also personality traits, the fact that there are certain triggers that influence whether people are more willing to learn new topics or more willing to gain from feedback within the workplace. And these have a long-term effect as well throughout life. So the measurement framework really focuses on a set of indicators, as alluded to before. And these indicators we recommend grouping into effectively three types. We have outcomes, which are the primary outcomes are skills and knowledge and human capital itself directly. And so we then have a set of input factors or input indicators which trigger or cause the change of human capital more directly. So the example given in this diagram is the set of skills required for an individual to go into the occupation of being a coach. So it identifies three skills that are required for that, and what are the knock-on impacts from having those skills onto earnings and potentially other secondary outcomes like well-being. Then you also have a set of enabling factors where you may not be able to attribute the direct relationship or the direct causal factor, but there is still a factor that influences that relationship, even if indirectly. This is per life stage, and it is per topic of what is the outcome at each life stage, even if a certain input might be influencing from a previous life stage. also important to highlight that skills from a younger life stage will then have a multiplicative effect onto later life stages. Our users also did request for a fourth type of indicator, which is a more contextual set of factors that don't fit directly into this framework. And we've also highlighted that there are other factors here in yellow that influence things like earnings that are not directly driven by an individual's human capital. So a couple of examples might be company profits or how much networking you do. And these need to be recognized, but they don't form a part of our framework because the focus is on what influences skills and knowledge directly first, and then what's the knock-on impact to human capital. So I will now fairly briefly go through a framework for how we might apply this to unemployment scarring. So this is the long-term effects.
Just a heads up, Georgie, that you have 5 minutes left.
Thank you. Okay. So yeah, so this is the effect of the effects on your labor market outcomes and potentially other impacts such as well-being that come about from having a period out of work, and particularly the focus has been on the further knock-on impacts that one bout of unemployment might have on future bouts. We've applied this relationship focusing on for those who have left their job, but ignoring the reason for why they have, but trying to account for that to some degree. So firstly, we consider the direct factors influencing on those secondary outcomes. So the economic context, local labor market conditions, which we in our model measure through the local labor market unemployment rate. There's a whole set of literature on the previous characteristics that influence on individuals, whether that's the industry that they were in or the length of time they were in that job, which we've identified purely with the previous industry due to data limitations. And there's a really strong relationship between the length of time you've been out of work and whether that's driving skills depreciation or whether that's simply a signaling effect. Although leaving job is not a factor influencing these things directly, it's an identification structure, because everyone who's identified within this has left their job. And we highlight that the reason for leaving might be one of the main factors for leaving itself. But rather than controlling for the reason for leaving, we then look at what are the knock-on impacts, knock-on causal effects for that. Whether this is to do with someone having a health condition and having to leave due to ill health, or whether that's due to having a disability that doesn't allow them to continue working, whether that's something that they have to stop in order to care for someone, or whether that's taking off maternal leave. And financial stability identified within our data through household income also comes through as the opportunity to look for another job or not becomes critical. And finally, just to finish off, the framework would describe that this actually has some of these factors have other wider relationships through things like discrimination, which cannot be explicitly identified. There are hidden factors such as motivation that have impacted on previous factors such as qualifications, and training is also another route into impacting on people's skills. Just to highlight finally that some of these factors also relate to another part of the literature relating to early life chances, which we also control for whether people have left at the age of 16 and their father's socioeconomic status. And that filters through into those categories as well. So with all of that in mind, I'll just show you some of our initial results. Just very quickly, on the left-hand side, you can see the effect that duration has on the likelihood of returning to work in the next quarter. These are all focusing on the likelihood of returning to work it's the first set of results. We'll be then looking onto the other wider outcomes just described. On the right-hand side, you could see the effect that local unemployment rate has, and how that actually has a bigger influence on those who are more recently out of work, where that's a between a 1.5 and 2 percentage point impact from a higher local unemployment rate. While in the bottom right, you could see the positive effect from training in the past year, but how this is more of an influence for the older age groups than younger age groups, where this might be to do with the signaling effect from having recently come out of qualifications anyway, so training may not have as big of a signaling effect. So just to bring it back together, the application of the framework we're looking on to apply onto a next set of topics, more on unemployment scoring, but also looking at the relationship between developing health conditions and ongoing labour market engagement, particularly later on in life, as well as how furlough is impacted on people's skills and knowledge directly, and how the pandemic has impacted on the children and young people's development. And just what's in common with all of these is that this really moves us beyond what we can do with our current human capital stock methodology. I will skip that. Just the final point around skills. So I've alluded to the fact that we're looking to measure skills more directly, and this is a really critical point that moves us into the realm of new data collection, which we haven't done in the past. But another angle we're pursuing is about using skills identified within online job adverts. This is an example from some incredible work that Nesta have done to date, visualizing the skills requested within job adverts and the taxonomy that they've created as a part of it. What we're recommending is then using such a skills taxonomy to link to the earnings being asked for within job adverts to get an effective market price of skills. And then this skills demand can be tracked over time for trends. Finally, just to bring it all back together, really, the summary is that we want to move beyond simply capturing the levels of human capital by bringing in other findings from other disciplines, and this focuses the measurement on change and development rather than levels, which is why we've brought in an encompassing framework to answer some of those questions. However, it does highlight evidence gaps. We do think it moves the conversation on to what are the mechanisms influencing that, how can they be leveraged against policy levers, but also it does identify what is necessary for us, which is a type of virtual data collection cycle where we identify evidence gaps and those feed back into data collection needs, as well as much closer links to academic research on such mechanisms influencing skills development. And just to give a final point, that this is part of a wider ONS development work plan relating to human capital, and it does link to other missing capitals within the National Accounts Framework. So what it allows us to understand is the different investments that go into human capital that would be accounted for in such an experimental set of accounts. But for this talk, I have focused on the other wider framework. So I appreciate we've gone a bit over, but I'll pass it back to Clona for any questions. Thank you.
Great, thank you very much. That was really interesting. So the Q&A is open, so if anybody does have any questions, please feel free to put them in. I don't think we have any at the moment, so I'll just kick things off. So when you've highlighted some of the future work plans that you have, they do seem to be responding very rightly to the big impact that COVID is going to have on all sorts of statistics and all sorts of aspects of daily life going forwards. So I was wondering if you could talk a little bit more about those work plans you have, but also just in general, the ways in which you think that human capital can provide an insight into the both the short-term and long-term impacts that COVID might be having, and how it might help people deduce that.
Sure, thank you. Yeah. So as I kind of rush towards at the end a little bit, the new framework we're considering applying can be applied to some of these really critical policy questions. So anyone who's even partly aware of the pandemic impacts will be strongly focused on things like the impact from learning loss of children, whether that's academic or social development or otherwise, and being able to identify what knock-on mechanisms the lack of study time, lack of teacher time, lack of being in school might have on those skills developments could then help identify potential interventions or potential catch-up help or other new policies that might come through. So this is one of the critical ways that we're considering how we may add some value within the office. It does generally open you up to the point that we would be looking to measure things that we haven't measured before. But in some cases, we can apply the framework where we understand how there might be the knock-on impact to, as I said, those primary outcomes, actually skills and knowledge. But you can then also attribute a secondary outcome, a secondary knock-on impact to things that people more easily measure, like earnings and employment status. So yeah, so learning loss of children is one aspect, and you can do that in the short term, as you say, by trying to identify what's happened to date, and in the longer term by monitoring this on an ongoing basis. And again, that feeds back into our data collection vision on that. Another angle is then, as I'd alluded to, is around how health conditions have been impacted. So again, the COVID focus there is about the missed appointments or misdiagnosis that people have had through the impact that the pandemic has had on the health system. And there, the relationship is around tracking whether those people might then have further projected impacts of their health conditions, and hence what is the relationship between them remaining in work, and that would have quite a large macroeconomic focus on the availability of working later into life, or whether upskilling is required.
Great, thank you very much. We've had a question come in, and so I'm going to pass it over now to Kishab.
Hi. That's a quite interesting topic and a very nice analysis. Just my question may be asking for some clarification or some highlights on how to handle the quality improvements in the services. In university system, always we talk about the high quality education. And then when in real life, I am not sure whether the human capital is utilized properly. So there may be significant amount of the human capital, potential human capital, that is left unused. So in your framework, how do you handle this type of issues? Thank you.
Yeah, thank you. That's a very good question. I think, I mean, a lot of this is based on what we can actually measure, if we are able to measure people's skills and knowledge in a consistent, ongoing fashion. But the framework explicitly consider that by being able to apply the return on skills from a particular investment versus the return on other outcomes such as earnings. And if there is quite a large difference in, say, the return on certain mathematical skills that don't translate into average returns on earnings, then there's clearly an under or over valuation of the investment that's being attributed to that skill. So it actually more explicitly allows us to identify potential underutilization.
Great stuff. So I don't believe we have any other questions, and we are bang on the half-hour mark. So shall we leave things there? And thank you everybody for coming. It's been really, I've learned a lot.
Yes, thank you very much, Tiana, and thank you everyone for attending. As we alluded to, if you want to continue the conversations with the speakers, you can pick that up in the breakout rooms in the coffee break just now. Thank you, everyone. Goodbye.